Hi guys, welcome back to Investor Prime. If you're new, make sure you subscribe and of course follow me on Insta at Investor Prime. Alright, let's get into today's video. So today's video, I'll be discussing with you day trading. Day trading is a very lucrative way of making money from the markets if done correctly. Is common in Forex and stock markets. Basically, you're in and out of the market several times a day using high leverage and short-term strategies to capitalize on small movements in the price. But in order for you to be successful at day trading, you basically need to be aware of any micro or macro news that could affect the share price or the currency price. Such news announcements include earnings reports for stocks. And of course, there's plenty more news announcements that you need to be aware of. You basically need to know on a micro scale what could affect the market that you're in. Basically, you need to be aware on a micro level what could influence the market price or the currency price of the market that you're trading in. And you need to be able to get out of the market very quickly if anything was to change, because the markets as a day trader changes very quickly, so you need to have a fast reaction time. Part of having this fast reaction time can be embedded in a solid strategy that you come up with. As a day trader, you're in and out of the market several times a day, so basically you're going to be paying a lot, or you could be paying a lot on commissions. So this is something that you should incorporate into your strategy and make sure you have it covered, that you calculate how much commission you could possibly trade. Let's say you're looking to place 10 trades a day, so you need to factor in the cost of those 10 trades in and out. So part of your strategy could be finding a broker that's cheap enough on commissions to allow you to do this. Usually brokers could say that they're scalping friendly, which means they're good for day traders. As a day trader, the markets could change very quickly and you're in and out of the market several times a day. This is very high risk. So I'm going to share with you a strategy that worked for me when I was day trading.
Alright guys, so a very good strategy to use for day trading involves using the Bollinger Bands. So the Bollinger Bands was developed by John Bollinger, and basically it's a trend following indicator that consists of 3 lines, a moving average and 2 other lines, upper and lower bands, usually separated by 2 standard deviations. In TradingView, you just go to the FX, which basically has all your indicators and all your strategies, and then you search for Bollinger Band. So basically that's what the Bollinger Bands look like. And then if you go to the settings, you can see basically the parameters. So the length is how many periods the moving average are, and the standard deviation is how wide you want the upper and lower band to be relative to the moving average. So we'll just leave it at 2 standard deviations. Okay, so that's what the Bollinger Band looks like. Alright, so as this is a day trading strategy, let's lower the time frame to a more suitable time frame for day trading. For day trading, you usually use anything less than 1 hour. Okay, so you can use the 1 minute, 3 minutes, 5 minutes, 15 minutes, 30 minutes, and 45 minutes. The reason for this is because you're in and out very quickly in the market. So you want a time frame that can basically show you opportunities as quickly as possible, and also show you when the opportunities are going in your favor or are going against you very quickly. So let's just go with 1 minute, for instance. Okay, this is highly rapid trading, like 1 minute. So for you to do 1 minute trading, your heart basically needs to be built a certain type of way to handle that kind of stress, in my opinion. Let's go to a strategy when I was day trading I used more commonly, so the 15 minutes. Okay, and this is a Forex chart, so the Euro US dollar on the 15 minutes. So basically the strategy I was using is, first of all, you identify which side of the trend you're on. So if it's a bullish trend, i.e. the trend has been going up, then you make sure you look for buying positions in the market. That way you're going with the trend. So this increases your chances of success. And vice versa, if it's a bearish trend, i.e. the trend is going down, then you look for selling opportunities in the market. And the way you can use the Bollinger Band to identify which side of the trend you are on is basically looking at the moving average, which is the middle line between the 2 bands. Okay? So if the price is above the moving average, then the trend is seen as bullish. So you look for buying opportunities. So as you can see here, the minute the price rose above the moving average and closed above it, then this presented buying opportunities in the market, and the price continued to rise until it pierced the outer band or the upper band, and vice versa here. As the price fell below the moving average, it continued to fall and even pierced the lower band about 3 times. Okay, so my strategy, basically, I'll wait for the price to reach the moving average and then see what happens, what the price does. So I usually wait for the price to come above. If I'm looking to buy, I usually wait for the price to come above the moving average, close above it, but I don't enter the market straight away. I wait for a confirmation. So usually the next session, I'll wait to see what happens. So basically, if the price rises, closes above the moving average, I'll be like, okay, I'm looking to go long on this, i.e., I'll be going with the trend, which currently is bullish. All right, but I want a confirmation that the bulls have actually taken full control before I get into the market. As you can see, this candle rose above and closed above the moving average. The next confirmation was also a bullish candle. So I would have waited and got in on this candle until the price rose and pierced the upper band. So that would be my indication to either relieve some of my positions or get out of the market entirely. And I'll be inclined to just relieve some positions or raise my stop loss. Okay, so I lock in a lot of profits, as it wouldn't make sense for me to get out of the market on this candle because the bulls are still in control. So as you can see, the next candle after that, the bulls were still in control. So I would have moved up my stop loss again, locking a bit more profits. Basically locked in this move. Okay, all the way up to maybe just below this candle, and wait to see what happens the next session. And the next session, the bears took control of that session. So I would have been inclined to either just get out of the trade or leave my stop loss here, just below this candle, just to see what happens if the bulls continue the trend. Okay, so let's look for a bearish opportunity. As you can see here, the bears took control, brought the price down below this moving average. Alright, so I would have been waiting for a confirmation, and the next session was this confirmation. But because the price was practically at the lower band, I would have waited to see if the price rose back up to this moving average. And the reason for this is part of how the Bollinger Bands work. Basically, if the price pierces or reaches the upper band, you can expect some correction of the market, either down to the moving average, or it could even correct fully and move all the way down to the lower band of the Bollinger Band. But it usually moves to the moving average and then continues. So I'll draw a couple of arrows just to indicate what I'm talking about. So for instance, if the price rose up to this band as it did here, I would expect a correction down to the moving average, and then this moving average will serve as a support, and usually comes down like this and then continues if it's an uptrend, if it's a strong bullish trend. That was not the case here, as the price broke through the moving average and continued falling. So what I would have been waiting for is, or expecting, is a price correction back to the moving average. And then if that happened, then my entry would have been at this moving average. Again, I'll wait for a confirmation at the moving average to indicate that the price is going to continue falling. Usually this confirmation would be a bearish candle around this moving average, and then I'll get in here. But that wasn't the case, as literally the price was hugging the lower band, indicating that this was a very strong bearish trend. So in this situation, you can be very aggressive in the sense that you can get in on this candle as this is a confirmation, this bearish candle as this is a confirmation, but set your stop loss above the moving average. Okay? So that way, if it goes against you and moves up to this moving average, you're still in the trade. So for instance, if it came up, assuming you've got in the trade on this candle, okay? It came up here, so right now you're at this loss, but your stop loss is up above the moving average, so you're still in the trade. And the minute you get a bearish confirmation that the trend is actually bearish, all right, here on this arrow, or assuming there was a bearish candle around the moving average, then what you can do is you can add onto your positions because you've got that extra confirmation and that extra confidence that you're on the right side of the trend. And not only that, it's actually an established bearish trend. But the most important thing of this strategy, as it's a day trading strategy, everything moves very quickly, is make sure you always have a stop loss. Because it's day trading strategy, you're looking for very small movements in the market, but you're using high leverage. So make sure you have a stop loss, and this stop loss must be tight. So you need to make sure you know where you're going to get out before you even take the trade, because this kind of environment is very easy for your emotions to set in and practically ruin a good trading strategy. So when I was trading the day trading strategy, what I'll do is I'll set a stop loss always just above a couple of pips. If I was in the forex market, a couple of pips above the moving average. The reason for this is if the price corrects itself, at least I have some cushion at the moving average, which will act as a support if I'm bullish, or act as a resistance if I'm bearish. And that way the price should correct itself and continue falling if it's bearish, or continue rising if it's bullish. So in this example of a bearish trade, where I would set my stop loss, okay, so because this is my confirmation, this candle, which means this is my entry. All right, this is my entry point. So my entry is at this red line. Okay, so my exit or my stop loss would be a couple of pips above this moving average, basically above where you enter. So the moving average where I enter on this trade is just at the arrowhead. Okay, so a couple of pips above that. So basically, when you're setting a stop loss, what you should take into account is your risk. How much percentage of your capital are you willing to risk? And then you factor this into your calculation. So this is my entry at this red line. Okay, so this is my stop loss. All right, so let's just type it in. Entry. Okay, so now I've established where my entry is and where my stop loss is if the market went against me. Okay, so now basically I need to establish where I'm going to exit on this trade. All right, so there's two ways you can select your exit or your take profit if you're right on this trade. And the first way is for you to basically determine your risk to reward ratio. So if you're risking, let's say 5 pips, okay, and you have a 2-to-1 risk reward ratio, you should be looking for 10 pip moves, okay? The second way is to allow the market to tell you when to exit, and that's the way I was using when I was day trading. All right, and how you can do this is to basically allow the market to be going in your favor, and you're moving your stop losses along the way. Or you can move your stop loss just above the moving average of the Bollinger Band as the market is going in your favor. So for instance, on this candle, you can move your stop loss from here to here because it's made a big move. And at least that move, if it goes against you and corrects itself, you've still got this moving average acting as resistance. All right, there is the chance that the move will be big enough to pierce the moving average and hit your stop loss. That's fine because you set out with a risk of 5 pips, but you got out the market maybe on 2 pips. So either way, your stop is less than what you set out. There's only 2 ways I'll ever leave a market. One is if I've hit my take profit, and 2 is if I've hit my stop loss. Okay? Either of those 2 ways is the market telling me when to get out. Basically, if it reaches my stop loss, then the market is kicking me out the trade. If it reaches my take profit, then I'm kicking myself out of the trade.
Alright guys, that's it for day trading. That's my take on day trading, and the strategy, if implemented correctly, could generate a lot of money in the long run. If you enjoyed this video, make sure you like, comment, and subscribe. And happy trading guys, and I'll see you in the next video.
It's not a game, it's a rich